Ladies and gentlemen, Joshua Salvetti, welcome to the High Performance Trader Bootcamp, right? And in lesson one, we are going to be breaking down the market auction, right? So this is a very important lesson. It's very important for you to understand actually what this market is, right? And the importance of price action, how price action is created, right? What goes into making a market, right? What moves the price action, right? And what chart patterns actually represent, right? Because for a while I did not understand this and it led to destruction for me on the market, right? So it's very important to understand what goes into this auction and what makes it move, right? Because for us, we need price to move to capitalize on profitable trades, right? So we're going to break right into it. What makes a market, right? A market is nothing other than two individuals agreeing on a price of a commodity, right? So the most fundamental component that goes into this market is the trader, right? Which is me, which is you. I don't care if it's a trading bot, algorithm, right? Whatever is buying and selling, right? That is the only thing that moves the market, right? So two traders, one buyer for every seller. That goes into agreeing on price. That is what goes into every trade, right? If I'm buying, someone needs to be selling. If someone's selling, someone needs to be buying, right? This is what creates price action, right? So there's two traders buying and selling with two different beliefs about the future, right? Because if I'm buying, I think price is going up. We could all agree that the motive for every trader is to make money, right? So if their motive is to make money and I'm buying, I believe price is going to go up. If you're selling, you believe price is going to go down. So two traders, two different beliefs, one will make money and one will not. This is a zero-sum game, right? If I'm making money, someone's losing money. If you're making money, someone's losing money, right? Someone has to pay for someone else's success, right? And it's all based on what happens in the future, right? So our goal as traders to make money. There's only two ways to profit in this game. That's buy low or sell high. So what moves price action, right? So this is very important. I'm not sure where you are in your trading career, but in my beginning years, I believed in indicators, the RSI, the MACD, the moving averages, the oscillators, all the mathematicians and mathematics that go into it. Ladies and gentlemen, all that is bullshit. Excuse my language. But the only thing that moves the market is supply and demand, right? So price movement is determined by the supply and demand of outstanding shares of a commodity. So remember earlier, we were talking about there needs to be two traders for every trade, right? Agreeing on a price. Now, if they're agreeing on a price, that means that they believe that that price is worth a specific price based on how much demand for shares is current and how much supply of shares is current. And what that means is out of, let's just say, 100 shares, if everybody wants them, right, that means more people are going to be buying, right, which is going to increase the price of the share, right? And when the supply is large, that means a lot of people are selling the shares, so there's massive supply for it, right? It's all supply and demand. So once again, as the demand for shares increases, price increases. As the supply of shares increases, price decreases. So supply and demand is the only thing that can generate price movement and is a direct result of the beliefs and expectations of traders, right? So remember, if the demand is heavy, right, that means a lot of buyers are buying. That means the expectations of those traders is that the price is going to go higher, right? That means they are bidding the price up. They consistently are bidding higher and they're paying a higher price for that commodity that was worth $10 cheaper a couple minutes ago because the demand wasn't as high, right? So, and how we break this down in a visual presentation is through supply and demand zones, right? And now how we identify those, I break into in a whole nother lesson, but just, real quick summary is over here at 376. Every time price comes into this 376 demand area, price goes up. This means every time we're in 376, there's large buyers. There's people interested in this commodity at 376. They think that is they agree that this is a good price for the commodity. That's why every time price comes into it, price goes up. And same with supply, but reverse. This 386. At 386, there's large influence, right, that the price is too high, right? So a lot of that gets sold at 386. A lot of those shares are getting sold at 386, right, which is making the price go down, right? So this is the imbalanced market of supply and demand. There's large supply up here, there's large demand in here. Everything in between that we call as the market imbalance, right? So this in between area is where we look to capture price movement going back and forth through supply and demand. These are magnets, right? And the reason that is because there's large money, smart money, banks, institutions, right? Influencers, market influencers that have so much capital that they actually can buy so many shares over here at 376 that as they buy it in large increments, the price is continuously rising, right? Because if they want to buy 1,000,000 shares, they can't just buy 1,000,000 shares because there isn't 1,000,000 shares available at that specific price. Because as they continuously buy so many lots, the price is going higher because the demand for that commodity is increasing, right? I hope you guys understand this. It's very important. And the same with supply. When they're selling millions of shares, they can't just sell it all at once, right? Because they won't get the best bang for their buck. If they sell it all at once, they might be able to sell 100,000 shares for 386, and then by the time they unload 100,000 shares, the price might be worth 376. So and then they go to sell another 100,000 and so on and so forth. So they need buyers to soak up their sell orders, right? So as buyers are soaking up their sell orders, they're continuously selling thousands, hundreds of thousands of shares at that high price, giving them the best return for their money. That's why large money is consistently outsmarting retail traders, and that provides liquidity for their large orders, right? So that is how the market moves. Okay, so market conditions. So you guys are going to hear me say this consistently, right? Adapt to market conditions, identify market conditions, right? And basically in a nutshell, market conditions represent the temperature of the overall state of the market, right? And we're talking bullish or bearish or range, right? So a bullish market conditions means buyers are in control, right? You got aggressive buying, right? They continuously bid the price higher, right? That means the demand is large, right? And in bearish conditions, you're getting aggressive selling, right? Where sellers are continuously selling, right? And they're making lower lows and lower highs, right? So an uptrend, price is making higher highs and higher lows. Demand is increasing. This is bullish. And downtrend, price is making lower highs and lower lows, right? And the supply of shares is increasing. It's very bearish, right? So there's bullish conditions, there's bearish conditions, right? And then it's trading in a range means it's very balanced, right? Kind of like what this picture right here. This is what you consider a range, right? So it's very important to understand before putting on any trade what the overall temperature of the state of the market is, whether it's bullish, bearish, or in a range. Okay, so chart patterns, right? So chart patterns is what we use to identify what we like to call an edge, right? So a chart pattern is observable, it's quantifiable, which means it can be measured, and repeat themselves with statistical reliability. So basically, in a nutshell, the chart pattern represents the collective mind of the market, right? Indicating when there is a higher probability of one thing happening over another, representing an edge. So when I talk about human behavior and chart patterns being collective human behavior, what I am basically saying is we have this demand zone over here at 290, right? So price comes into 290, buyers show up, and then the sellers bully it back down to 290, and buyers then defend this area, right, with statistical reliability, which basically means it has happened before and there's a high probability it's going to happen again, right? So this is what defines our edge. We identify these areas, right, on the market, on the chart, and then we look for these chart patterns, right, that represent human behavior. Remember, we need large money to make a move, right? So as we see these chart patterns, we identify large money's behavior through them. This is where we look for entries, exits, targets, stop losses, everything you need to put on consistent, successful trades comes through chart patterns, right? So really cool stuff. It actually, when I first started trading, this was kind of like a video game to me. When I seen a chart pattern, I just went long. But now that I understand this as an auction, I see a chart pattern, I go, hey, there's large money defending this area. This is where I should put in a long order, because if they're defending this area, that means they want this price. And if they want this price, that means price is going to rise. If price is going to rise, that means I'm going to make money. So I'm going to put my order in, based on this information, based on market conditions, and I'm going to target X based on previous price patterns, right? And I'm going to make money on this consistently, right? So basically, in a nutshell, this identifying market conditions, all this goes into identifying smart money, right? Because retail traders, we do not have the capital or influence to move the market, right? We don't have the amount of money. We don't have it. Just that's basically what it comes down to, is we don't have hundreds of thousands of shares to buy and sell, right? So since we need the market to move in a specific direction based on our analysis to generate profits, we must learn to understand the conditions of the market and who is controlling them to become consistently profitable. We do this through price and volume analysis, right? So basically, in a nutshell, ladies and gentlemen, we learn to adapt to these market conditions so we can identify smart money and what they're doing in live time. If we can understand where they're going long, where they're going short, we can then capitalize on these movements consistently, right? We do this through price and volume analysis, and we are going to break down all of our favorite strategies, tips, tricks, everything you're going to need to know in this course, right? So I will see you in the next lesson.